Imagine being like the undisputed golden child of global finance for an entire decade. You're the growth engine everyone wants a piece of.
Right, the absolute darling of emerging markets.
Exactly. And then you wake up one morning and a massive chunk of your biggest institutional fans people, controlling hundreds of billions of dollars, are just quietly walking out the back door.
It's a stunning reversal.
Yeah.
I mean, we are witnessing a fundamental re-rating of India's position in the global capital stack.
Yeah. And it completely challenges these investing orthodoxies that portfolio managers have basically treated as gospel for years.
Yeah,
So today, we're doing a deep dive into this really jarring reality check.
and we have some very fresh data to unpack for that.
We do. There's this revealing new report by Mahesh Nandurkar, who's the India strategist at Jefferies. He recently sat down with over 50 major U.S. investors.
Right, over 50.
Yeah. And the resulting report lays out this very clear, very stark picture, which is that the smart money is aggressively hitting the brakes on India.
They absolutely are.
So our mission today is to figure out, where that capital is actually fleeing to, why the math suddenly stopped working for foreign portfolios, and ultimately we'll look at the rather unorthodox survival playbook Jefferies is recommending to survive this shift.
Because to understand the gravity of this pivot, we really have to look at the mechanics of how money actually flows into developing nations.
Right. This isn't about retail day traders clicking buttons on their phones.
Exactly. We were talking about institutional titans who, they physically move markets when they decide to reallocate.
I want to look at the sheer scale of this capital flight first, because the raw data from March 2026 that Jefferies pulled is frankly staggering.
It really is.
They analyzed 70 large emerging market funds, or EM funds, and combined, these funds manage a massive $320 billion in assets under management.
That is a massive pool of capital.
Right. And out of that pool, 61% of these EM funds are now actively underweight on India.
Wait, 61%?
Yeah, 61%.
Wow. I mean, that figure is the signal of a systemic rotation. It's huge.
Because historically, that wasn't the case, right?
Not at all. Historically, if you managed an emerging market fund over the past 10 years, you didn't just meet the MSCI benchmark weight for Indian equities. You held a 2 to 3 percentage point overweight position.
You basically had to, right?
Yeah, you fundamentally needed that structural overweight just to keep up with the performance of your peers.
Because if you weren't overweight India, you were effectively shorting the best performing growth story in the developing world.
Exactly. The baseline assumption was always that Indian equities had this permanent premium built in.
Due to the demographic dividend, the massive infrastructure build out, all that stuff.
Right, all of that. But today, that historic 2 to 3% overweight has violently swung to a 0.4 percentage point underweight compared to the MSCI EM index.
That is wild. It's like, okay, think of India as the reigning high school prom king, right?
Okay, I like this.
For years, everyone wants to sit at his table. And then suddenly he walks into the cafeteria and finds himself sitting completely alone.
That's a great way to put it. The constant, reliable bid that has been sitting underneath Indian equities for a decade is just suddenly gone.
So my question is this just a temporary mood swing from foreign investors? Or is the data telling us something fundamentally changed in the Indian market?
When that structural bid vanishes, the underlying mechanics of the market change entirely. Without that steady influx of, passive and active foreign capital acting as a floor, domestic markets become incredibly vulnerable to valuation reality checks.
Valuation. So it's about the price tag.
Exactly. Investors looking at that 0.4% underweight are signaling that the risk-reward ratio has completely inverted.
So they see the same demographic and infrastructure story we've all been sold.
But they've decided the entry fee is simply too high for the actual yield being generated today.
Well, I was digging into the MSCI India Index to understand that entry fee, and it is currently trading at roughly 19.8 times its one-year forward earnings.
Which is steep.
Undeniably steep for an emerging market. I mean, we're talking about a 70% premium compared to other emerging market peers.
A 70% premium means you are paying nearly double for a slice of Indian corporate earnings compared to what you would pay for similar earnings in, say, Brazil, Mexico, or Indonesia.
Right.
To justify that kind of multiple expansion, a market basically has to deliver absolute perfection in both macroeconomic stability and corporate earnings execution.
which is almost impossible to maintain.
Right. Any friction in either of those engines means that premium morphs from a sign of strength into a massive portfolio liability.
And we are definitely seeing severe friction on the currency side.
Oh, absolutely. The currency piece is critical here.
Because it's one thing to pay a 70% premium if the underlying currency is a fortress, but the Indian rupees dropped about 5% year to date in calendar year 2026 alone.
Yeah, the depreciation is accelerating.
And if we zoom out and track it back to September 2024, the rupee is down a cumulative 13%.
A 13% drop is massive for foreign investors. If you are a U.S.-based fund manager, that currency drag is actively destroying your alpha.
Right, because you have to convert your dollars to rupees to buy the stock.
Exactly. And if the rupee loses 13% of its value, your underlying equity pick has to generate a 13% return just for you to break even on the exchange rate alone.
That's a huge hurdle. It's like, okay, if I'm paying a 70% premium for a luxury car, I expect luxury performance from it. But with the rupee sliding 13% since late 2024, it sounds like investors feel they're paying luxury prices for a depreciating asset.
That currency mechanism is basically the silent killer for emerging market portfolios.
Is the growth actually there to justify any premium right now?
Well, when you pair a 19.8x forward PE with a depreciating currency, you create a highly toxic environment for foreign capital.
Yeah, that makes sense.
The structural issue driving this rupee weakness involves, persistent trade imbalances and inflation differentials. The central bank struggles to offset these without simultaneously crushing domestic growth.
So foreign investors evaluate this and see a scenario where they are taking on venture capital levels of valuation risk.
But getting hit with emerging market currency devaluation on the back end,
It completely breaks the math.
it really does.
If you're holding Indian index funds right now, you have to decide if that 70% premium is still justified when the denominator, the currency you're eventually going to repatriate your profits into, is leaking value every single month.
You're buying an asset priced for absolute perfection with a currency that is demonstrating material structural weakness.
It's a tough sell.
And those 50 U.S. investors Jefferies interviewed, they made it abundantly clear that they are not evaluating India in a vacuum.
Right, they have other places to put their money.
Exactly. The decision to pull back isn't just about India becoming too expensive on its own merits. It's about alternative global markets suddenly offering a much higher velocity of capital.
And here is where we get to the giant AI distraction.
Yes, the gravitational pull of artificial intelligence.
Because global capital is essentially chasing the AI dragon right now. The Jefferies report specifically calls this the ADRAM distraction.
It's a great term for it.
It really is. And it's pulling institutional liquidity directly out of India and funneling it into the markets that house the primary beneficiaries of the AI hardware boom.
We are tracking unprecedented earnings upgrade cycles for companies like Samsung, SK Hynix, and TSMC.
The big hardware players.
Right. Because the physical infrastructure required to train and run these massive language models relies entirely on advanced dynamic random access memory chips, DRAM, and cutting-edge foundries.
So as U.S. tech giants pour hundreds of billions of dollars into AI capital expenditures, the immediate tangible beneficiaries are these specific hardware manufacturers in Asia.
Capital always flows toward the most visible, immediate earnings growth. And right now, that sits squarely in Taiwan and South Korea.
It's a fascinating dynamic of capital velocity. If we think about it like different asset classes, India is currently priced like a hypergrowth tech startup with that 70% premium we talked about. But its actual corporate earnings growth is starting to look more like a slow and steady utility.
Meanwhile, the AI hardware sector is offering actual, demonstrable startup-level hypergrowth today.
So institutional money naturally rotates toward the higher velocity. I mean, it's like a casino.
How do you mean?
It's like everyone is crowded around this flashy new AI roulette table, right? And they don't want to walk away to play the slow and steady blackjack game in India until they know the AI table has gone cold.
That's a really accurate comparison. Why wait 5 years for India's infrastructure investments to trickle down to corporate bottom lines when TSMC is posting massive upward revisions this quarter?
Exactly.
The opportunity cost of waiting on India's long-term story is simply too high for portfolio managers who are, graded on their quarterly performance.
But wait, doesn't India still have good underlying growth if you look past the tech hype?
Well, this is what makes it truly damning for India's current valuation. What happens when we adjust the data to remove the AI distortion entirely?
Let's hear it.
Let's assume the AI hardware boom is a once-in-a-generation anomaly. If we completely strip out Samsung, SK Hynix, and TSMC from the emerging market equation to see the underlying baseline,
Yeah.
India's earnings per share growth still trails behind its much cheaper EM peers.
Oh, wow. Ouch.
Yeah.
That is the real gut punch.
It is.
So it's not just that AI is sucking all the oxygen out of the room. It's that even in a complete vacuum, without those AI heavyweights skewing the averages, India's fundamental corporate earnings growth does not mathematically support its 70% valuation premium.
Right. Mahesh Nanderkar noted that institutional investors are heavily sidelined, essentially waiting for this specific AI and DRAM theme to peak.
They're waiting for the fever to break.
Exactly. They need to see the earnings momentum decelerate in Taiwan and Korea before they feel comfortable rotating capital back into a market as expensive as India.
So they do recognize the long-term story.
Oh, they recognize the long-term structural tailwinds in India, absolutely. But the near-term tactical play is to ride the AI hardware cycle until the wheels fall off.
Which creates this massive institutional FOMO. Even if a fund manager fundamentally believes in the Indian growth story over the next decade, they risk severe underperformance in the next 12 months if they don't allocate heavily to the AI supply chain.
They are forced to abandon expensive, long-duration Indian equities to chase the immediate high-beta returns of the chip makers.
So if foreign money is staying away until the AI frenzy cools, what do you do if you are investing in India right now? Like, say you have to have capital deployed there.
This creates a unique dilemma, but the Jefferies report provides a highly specific, very aggressive pivot to navigate this exact environment.
Okay, what's the playbook?
They are advocating a massive reallocation away from broad index exposure and expensive consumer or tech-adjacent sectors,
And moving into what?
moving directly into hard assets.
Hard assets. Okay, so we're talking about the physical backbone of the domestic economy.
Exactly. Power utilities, hospitals, airports, and real estate.
They are essentially telling clients to buy things with concrete foundations and physical toll booths.
Right. Highly tangible infrastructure.
And the weighting here is what really caught my attention. The Jefferies model portfolio now carries a 20% allocation to these hard asset sectors.
Which is huge.
It is. To put that in perspective, those same sectors make up only 8% of the standard MSCI India benchmark.
Right, so overweighting these assets by 2.5 times the benchmark is a massive defensive mover.
So by overweighting these hard assets at 20%, is Jefferies basically telling us to hunker down in the physical economy while the digital economy sorts out its valuations?
That's precisely it. The mechanism driving this 20% overweight relies on inflation-linked pricing power and heavily regulated cash flows.
Make that real for me.
Well, in an environment with a depreciating currency and elevated market multiples, you want to own assets where the revenue generation is unavoidable and easily adjusted for inflation.
Okay, like a hospital.
Yes, a hospital can immediately adjust its bed rates to match rising costs. A power utility passes its fuel costs directly to the consumer through regulated tariff structures. An airport collects landing fees that are often dollar-linked or contractually adjusted for inflation.
So these businesses possess a tangible pricing power that basically insulates them from the macroeconomic volatility hitting the rest of the market.
Precisely. It completely bypasses the global tech rotation.
I love that. When the tech and AI world feels dizzying and expensive, there's just something comforting about things you can physically touch. Yeah.
Right. If global funds want to play roulette with AI hardware multiples in Taiwan, that's fine. But the domestic Indian economy still needs electricity today.
Yeah, it still needs domestic flights, and it still requires medical infrastructure.
Exactly. By rotating into companies highlighted in the report like JSW Energy, AESL, and Premier Energies in the power sector,
Right.
or Adani Ports and GMR Airports and Logistics, you are locking into domestic consumption that cannot be outsourced or disrupted by a new generative AI model.
And they mentioned real estate too, right?
Yes, in the real estate sector, Jefferies points to major developers like Lodha, which operates as macrotech developers, and Godrej Properties.
Because real estate is the classic inflation hedge.
It acts as a classic hard asset sponge against currency depreciation. When the rupee loses purchasing power, physical land and property historically absorb that inflation and retain their relative value.
So by anchoring 20% of a portfolio in these concrete, highly visible cash flow generators, investors create this massive shock absorber against both global capital flight and domestic currency erosion.
It is a strategy of avoiding the valuation trap by fundamentally changing the game you are playing.
Instead of paying a 70% premium for future abstract growth, You buy the underlying physical infrastructure that the entire country relies on to function right now,
You are prioritizing absolute visibility of earnings over speculative multiple expansion.
which is so smart.
This pivot highlights a critical reality of investing during structural market transitions. The broader index might look terrifyingly expensive and structurally vulnerable.
But beneath the surface, there are always sectors that offer mechanical advantages against the prevailing macro headwinds.
Exactly.
All right, so if we pull all this together for you listening, the landscape for Indian equities has fundamentally shifted. The decade of easy, passive foreign inflows acting as a permanent floor is over.
It really is.
We have $320 billion worth of institutional EM funds actively choosing to be underweight because a 19.8x forward PE paired with a 13% currency drag simply destroys the risk-reward equation.
Yep.
And with the entire financial world currently hypnotized by the AI hardware supercycle in Taiwan and South Korea, India is largely being left to its own domestic devices.
Which means the defensive posture of hiding in hard assets, power grids, hospitals, airports, real estate, is the logical mechanical response to this specific environment.
Absolutely. But before we wrap up, I know you wanted to leave us with something to think about regarding this whole dynamic.
I do. This current dynamic forces us to consider a rather profound future scenario regarding the flow of global liquidity.
Let's hear it.
If global capital is currently ignoring emerging markets and starving them of liquidity to feed the AI capital expenditure boom, what happens to the pricing of global infrastructure when this AI hype eventually normalizes?
Oh, that's interesting.
Because hardware cycles, no matter how revolutionary, always face eventual margin compression and cyclical downturns. When that institutional money inevitably rotates out of the crowded AI trade, will we see an unprecedented, violent tidal wave of capital flooding back into these fundamentally sound physical hard assets in places like India?
Wow.
And if that happens, will the investors who waited for the AI dust to settle find that they are entirely too late and the entry price for airports and power grids has already skyrocketed beyond their reach?
That is the ultimate risk of market timing, isn't it? You step out of the room because the cover charge got too high, only to realize later that they completely changed the venue while you were gone.
Precisely.
Thank you for joining us on this deep dive. Keep questioning the consensus, watch where the smart money is actually flowing, and we will catch you next time.